I'd like to introduce, again, our illustrious speaker, Amit Bhatti. He's our resident legal expert at 500 Startups. He's our US-based corporate counsel, where he oversees investments from 500's flagship funds. Prior to 500, he was an attorney at WSGR, where he represented tech companies across all stages of their life cycle, from startup to IPO, and he has as well has a number of VC funds and making investments. He's been helping them make those investments as well. With that, I'm going to pass it off to him. He's going to explain a little bit more about his experience and why he's such an expert in due diligence, and then we'll get started with the webinar. Thanks again.
Thanks, Patrick. And hello to everybody that's joined the webinar. Glad you could make it this morning or afternoon, wherever you happen to be. Yeah, I think Patrick covered the background pretty well there, but just to give it a little bit more color, I've been with 500 for a few years now and supervise the diligence process of all of our accelerator investments, as well as in my law firm life, having spent many days and nights pouring through the diligence, both from the investor side and producing the diligence when representing early stage companies. So have seen it from both sides of the table, particularly on the legal side. We'll touch briefly on some commercial legal points, but we'll also have an upcoming webinar in the next month focused exclusively on early stage commercial diligence. So with that, here today we're going to try to cover the basics of what due diligence is, when you should be doing it, what level of due diligence you should be undertaking for an early stage company, some common things you would look at for an early stage company, and how that changes over time. So without further ado, let's jump into these slides. So the first thing we have here is just the absolute basics for those that haven't been part of a diligence process before. And really, I think the most important thing to focus on as you're going through a diligence process is to remember why you're doing this. And you're doing it to verify the information, your expectations, what you have heard from the company, what the company has told you. It's not to discover every single thing that has ever happened with the company. Realistically, when you are looking at a startup, you don't expect everything to be perfect, but you want to make sure that you're not taking on more risk than you're aware of. You want to know that, okay, if there is a problem, I've seen it and I know what it is. So it's not just that if you are going through a diligence process and something is not perfect, that doesn't mean the deal dies. It just means that the process has worked as expected, and you've gained some piece of information that should affect your thinking, maybe about your valuation or maybe some additional terms you want to add into the deal, but it doesn't necessarily have to be a deal killer. So when you start going through the diligence process, it kind of depends on what type of diligence you're doing. Obviously, you're going to want to go through a significant amount of commercial diligence to decide whether or not you're going to offer a company a term sheet or move forward with an investment. But necessarily, you're not going to want to spend a lot of money with third parties or undertaking significant legal diligence with your law firm or whoever it might be until you've actually signed a term sheet or an LOI. So typically at that point, you'll kick off a formal diligence process, maybe with a third party. So moving on to the who portion, the commercial diligence is typically coming from the investing team if you're at an institutional investor. If you're an angel just getting into this, that commercial diligence is going to fall pretty squarely on yourself or maybe an angel group you're a part of. Sometimes they're sharing resources and helping each other evaluate from the commercial point of view. When you get into legal or tax, sometimes technical diligence, like a code review or something of that sort, you would outsource it. And I've put those $3 there to indicate that those bills will add up fast. Typically, these things are done hourly, and It takes quite a lot of time to pour through, pages of documents that a company produces. As anybody that's seen a data room knows, there's a variety of levels of organization. Sometimes it's just a full-on document dump, and then you're just paying somebody to page through, any number of things. So diligence can become a very expensive issue, and that really affects what you do on early stage diligence. Another important factor on the who is that you're typically relying on the lead investor to do most of the diligence, especially for a priced equity round. The commercial diligence, you're going to make your own choices on whether or not you want to invest in a company. But in terms of the actual legal, tax, and sometimes even technical diligence, is things that you might just be following on into a round if you're not leading. And you're not going to have necessarily the same level of access, but it never hurts to ask. So in terms of the where, we've got, as I mentioned, typically you'll have a virtual data room, which could be very formal, like in an M&A transaction, where there's password protected and every document is watermarked to make sure that nobody is sharing the documents inappropriately, or as we typically see with early stage companies, a Dropbox folder, a box folder, with just a variety of documents included. If there's something that you require that a company hasn't provided, you should always feel free to ask. Especially at the early stages, you're generally going to have to drive the process, especially if it's a first-time entrepreneur. So it's helpful to decide on what's important to you, put together a checklist, and send that over to the company so they can start producing things that you want to see. So talking about what you do want to see, there's a variety of areas people normally look at when they're doing due diligence on an early stage startup. One is obviously the commercial points. You want to see maybe a product demo. You want to know what the user experience is. You want to understand what their target market, how large their target market is, especially for an early stage company. That can be one of the most important factors is, are they addressing a large enough problem? You also want to look into the team and the founders. You wouldn't take on a renter in a rental property without doing a background check, but many people invest in startups without doing the same for the founders. So completely reasonable to be doing a back or some reference calls about the founders. There's technical diligence you could undertake. You could go, depending on your level of expertise, you could review, get into the bones of the product if the company wants to let you see that. You could get into you absolutely should get into the very basic legal items that the company is providing, but you could get into customer contracts and a whole host of issues there. Financial diligence is going to be very difficult for an early stage company, but once a company has become revenue generating, is building towards a Series A, it's very common to expect to see at least basic financial statements. And then beyond that, depending on where the company is incorporated and where you are located, there could be a significant amount of tax diligence just in determining whether or not the investment is feasible. So today we're going to focus mostly on early stage diligence. So by their very nature, early stage companies have almost nothing to go on. Sometimes they haven't even incorporated at the time you begin talking to a potential deal. If they have, they generally have very little legal documentation. They might not have any financial statements. They're certainly not going to be audited entities. Any projections that you've gotten from the company on what their financial projections are realistically not going to be worth much more than the paper they're printed on. So a lot of times people, when they think about early stage diligence, they fall into immediately questions on how do I evaluate the company? How do I put a valuation on the company based on, a discounted cash flow model, or how can I project what the valuation should be based on, how much revenue they made in the last month or year. It's hard to make any realistic financial analysis based on the data that you have for a very early stage startup. Every investor has slight differences to the way that they do it. It would be, false to say that there's one correct way to do it. Because your investment itself in an early stage company is going to be relatively smaller, typically maybe $100,000. It could be slightly larger if the company is raising more money, but at a pre-seed stage, it's not going to be a very large check. So you're not also going to be very willing to shell out 10, 20, 30% of that in costs just to do a very thorough due diligence process. So it's a weird situation where these are the riskiest companies and investments you could make, but you're also necessarily going to do less diligence just because at some point it's not worth it. So I've picked out a couple areas that's really what we find to be key in focusing on when you're doing diligence for an early stage investment. And those are, you really want to make sure you feel comfortable with the team and you believe in the team. So diligence related to that area is absolutely key. You really want to make sure that there's the possibility for it to grow into a large enough company that your early stage investment will make the kind of returns you're looking for. So the market and properly understanding the market assumptions that either the company has given you or what you're internally deciding is very important. It's very important to understand to make sure that the basic legal structure of the company is in place. And the reason I say that is not just because it's been my career, but essentially your only rights to anything from this company are coming from the legal documentation. So if the legal documentation isn't correct and you made an investment that wasn't approved by the board or something of that nature, then maybe your investment wasn't actually properly done and it needs to be redone at a different price with different tax implications. It can be a huge issue. And I've included IP because depending on the type of business that you're investing in, that could be a very important early stage discussion as well. If it's a biotech or a hardware company where there's going to be a lot of hard IP, that would be important to explore at the very early stages as well. So I've put together a little list here of some sample commercial diligence items. Particularly in the areas that I mentioned for early stage companies on the left side of the screen here. For the team and the founders, it's extremely common at an early stage to do at least some basic background checks, reference calls to either prior employers. You might want to talk to, other people that have invested in this company, whether it's if they've gotten to that point. You want to make sure that their experience is relevant to the startup that you're investing in. If somebody presents you a pitch deck that has, they worked at Google and Facebook and LinkedIn, but their roles at those companies had nothing to do with the company you're now investing in, do those logos really matter to you? So it's important that you're understanding really who it is that you're investing in, because that's really who you're betting on here, especially at such an early stage. We see companies pivot all the time from, when we initially invested, they had one idea. The founders were smart enough to realize that wasn't what was going to take them forward, and they were able to think through the issue and make a pivot that worked. So really, it's the team that you want to be most confident in. The last item under the team I've put here is the level of commitment. And the reason I included that is we're often thinking about, is the founder that we're investing in committed to this company and to this idea to see it all the way through? If somebody is currently still working somewhere else, part-time on an idea, are they really going to want to work on this and fight through any challenges they get? Are they really going to want to take it when they get a first M&A offer at a very low valuation that wouldn't actually bring you a good return? Are they really going to want to push through that and try to build, the next unicorn? It's important to really think about all those things when you're evaluating the team. As far as market diligence goes, the first thing on there I would say is reviewing the market size assumptions. Every pitch deck, you'll see talks about how large the addressable market is for this idea. You really want to dig into what those assumptions are and make sure they align with what you think they are. You might make your own evaluation of what that target market is. You want to understand who their competitors are. You want to understand how well they already have, or if they're still trying to find a product market fit. You want to understand the viability of their sales channels. What's the cost of them? I would talk to customers if they already have them, whether it's a list they provided to you or whether you, and you should pick and choose, to get a sense of the real experience of those customers. Some other items people typically do with early stage companies is a basic demo to understand the user experience of whatever the product is. You might want to look into the scalability of what they're doing and understand what's on the product roadmap. Often a very early stage company doesn't have very much built out at all. Depending on if it's an IP heavy company, you might want to understand if they've got any patents in the works, what the defensibility of the idea is. And if it's extremely IP dependent, you might want to get a third party review, even as early stage investment. For financial diligence, we already mentioned on an early stage company, it's really hard to rely on any projections that they've given to you. But if that's something that you're evaluating when you're making this decision, you really want to make sure that the assumptions they're making are sound in your opinion. So dig into the model, see what they're using, see if you agree. Maybe you made your own, and see and ask these questions to the founder. Going back to something I mentioned earlier, if something as you're going through this process doesn't line up with what you expected, I think it tells you a lot about the team and the founders if you discuss it with them. And is it a mistake they made that they can learn from? Is it something where you believe that they, maybe just don't understand the issue fully? I think you can learn a lot through that process. And further on the financial diligence, there's obviously the unit economics that you can drill into. With early stage companies, sometimes those are kind of still changing, where they might not be the most reliable figures. So with early stage companies, it's always best to think about things with a little bit of a grain of salt. So the next slide here is a sample legal due diligence checklist. And this is a list that we go through with every single one of our San Francisco accelerator companies. So I'll walk through what these items are and maybe touch on a few comments of why these matter. So the first is the certificate of incorporation, the bylaws of the company. As an investor, you want to make sure that really that they have like the right number of shares authorized that you expect. There are companies we've seen where, they've authorized 1,000 shares and they send you over a cap table with, 1 million shares issued to 4 different founders. You really want, that's the basic governing document of the company. So you really want to make sure you get a copy of that. You want to make sure you see that the board has been appointed. Plenty of times founders want to cut corners on the legal, which I completely understand. It's not something where they want to make a heavy investment at the beginning, and I'm actually supportive of that. But you want to make sure that they're not just casually saying so-and-so is a board member and having them sign and authorize documents that they actually have no authorization to do. We also look at the initial board actions of the company, making sure that they've appointed officers, they have signatories. If they've created an option pool, you want to make sure that it's been authorized by the board, by the stockholders. So when people are being issued stock, it's actually valid. You want to make sure you see the founder stock purchase documents. Again, a lot of these are going to be related to stock and ownership because, again, all of your ownership is going to flow from legal documents as well. So the founder stock purchase documents are important because often they have vesting included. And when there's vesting for a founder, you have to make a tax filing in the US called an 83B. It's a very, boring tax and legal point, but if it wasn't done in the first 30 days after the stock was purchased, it's not something that can be done or fixed later. Most issues with diligence you can fix. An 83B filing is not something that can be fixed. And that can result in a big tax liability to the founder. And down the line, as your Series A, Series B, Series C investors look into the company, they're going to ask about this same issue, and they're not going to want to pay for the tax liability that comes to the founder. So it's really, really important to make sure you identify this as early as possible and then start to see what can be done about it. Mentioned before, employee option grants. You want to make sure that there has been a properly authorized option pool if any options have been issued. There's something called a 409A report, another tax-related point, but if any options have been granted, it's really important that you ask the company if they have a 409A report. This is something that gives employees a safe harbor that when they've been granted options at a certain price, that it's determined that it was granted at fair market value. If a company doesn't do this and has, say, sold stock for $1 a share to a bunch of different investors, and yet is continuing to give stock option grants to their employees at 2 cents on that same dollar, those employees are going to be looked at as having got 98 cents of income on each share. So it would make a whole lot of the team of the company that you're investing in upset if they immediately found out that they have a huge tax bill waiting for them. So it's really important that you get that you verify that this is being done correctly. Otherwise, it's an issue that the company is going to have to start to solve and have to spend money solving. So if you're putting money into the company, you don't want them spending it on solving legal issues. You want them spending it on building the product that you are excited about. Further on this list, we've got a detailed cap table. On that, we typically ask for them to represent all of the other convertible securities they might have entered into. As many of the angel investors that are on the line are probably well familiar with, often with these early stage companies, nobody's really selling shares directly. They're all raising money on a safe or a note or the 500 version of the form, which is a KISS. You really want to make sure you get the detailed cap table listing out all of the ownership, all of the grants, all of the convertible securities the company has entered into. Then the last two items are the IP assignments / employee agreements. These are typically rolled into one document. You want to ask for one of these for every employee that the company currently has. Typically, it's only a few people at this stage, but it's very, very important that all of the people that are actually touching the product or working on, the basic code or whatever it might be for the product for the company that you're investing in, that they've assigned all of that IP to the company. And that includes the founders. If a founder hasn't made that assignment but has built most of the product, then that founder technically owns that code themselves, not the company, and you're investing in the company. So you really want to see that all of that has been properly assigned. Then the last point is you want to make sure that there's a board approval of your investment. So, a lot of times investors will just sign on to a note and wire the money and what have you, but you want to make sure that the board of the company has actually approved this. Especially if you're buying stock directly, you want to make sure that all issuances of stock are properly done. So some common issues that we see all the time in our legal diligence is we see incomplete information, I would say in 95% of companies. So circling back to the very first thing we talked about, that doesn't mean that we don't do the deal. We want to make sure we understand what's missing, how it can be fixed. And sometimes we might add in post-closing covenants, asking that the company get a certain thing done in the next 30 days after closing. But really, you want to identify where the gaps are and what's missing. I noted especially records of stock ownership. That's typically something that you're not going to close over top of. You want to make sure that the stock ownership and all of the cap table is very, very clear and backed by documentation. So that leads to the next point, which is we often see that a company has no cap table, or they've got several different back of the envelope type versions of a cap table. When you get a cap table from a company and they say, oh, we've got, only 1 million shares outstanding and they're split between me and my founder, and you can invest for X percentage of the company. The cap table should be backed by documentation. So the cap table itself isn't binding on anyone. The only documents that matter are the actual legal documents that issue the stock or issue the options to, or the board consents that are issuing any of these items. If you see a cap table that doesn't come with any documentation, you don't necessarily know if that's actually what the company has done. We see missing IP assignments all the time. So typically we would have companies get those signed before closing as well, especially if it's an important employee. If it's, say, the new executive assistant or the new marketing intern, it might be less important than if it's the CTO. So that's a case-by-case basis that you might decide, okay, we can close without someone getting an assignment from every single person, but if it's a key person, you want to make sure it's there. Also, every IP assignment at the very, very back typically has a page for whoever is signing it to list exclusions from that IP assignment. So if you ever see exclusions on an IP assignment, you want to make sure you understand what those are and that they have nothing to do with the company you're investing in. Otherwise, the company you're investing in might not actually have the IP rights to some important piece. So touched on this before, but shares and options which haven't been granted by the board is something that we see often. If it's just a promise that's been made to the companies, that's fine. Often we see companies say we've promised options to these people. They haven't been issued yet. At that point, we always advise them, please get a 409A evaluation before you're issuing these options. You could incur a real issue for your employees. And like we said, with an early stage company, the most important thing is the team. And if you infuriate your team by giving them huge tax bills because you didn't issue options correctly, it would be a problem for all parties. The last issue that I've included on the common things that we see is possibly a unique 500 thing, but something we see more and more often as VC becomes global. We often invest in companies that are not US based. We invest all around the world. And you'll see that many people always say you need to start with a Delaware C Corp or something of that nature to get VC funding. So companies will open a Delaware C Corp. You'll be investing in that entity, but you really need to make sure that that is actually the parent entity of any other subsidiaries they might have in the countries they're operating in. So say, for example, you have a company based in the Philippines or based in Korea, based in Europe. If you have an operating entity there that is not actually 100% owned by the Delaware C Corp that you're investing in, those are two very separate companies. And if that's the company with all the IP and all of the users and all of the revenue, you've kind of just invested in a shell company. And in our experience, this is never done as a, as a fraud. It's just something that's overlooked in the diligence process, especially when investing in international companies. So would caution you, if you're going to invest in a company that has significant overseas operations, to make sure that all of the companies are connected. And the last huge point in a giant box is making sure that all documents are signed. It's one thing to get a document that's been produced by the company and see that, all of the words on the page look correct, but if it's not signed, it's not relevant and it's not valid. So please make sure that everything that you're looking at is signed. So the last point to make here is the changes as a company grows. So we talked about early stage diligence, and honestly, we talked about it in enough detail that it might be as much diligence as you're going to do on some of these very early stage companies. But as the company grows, Series A and beyond, they'll have much more documentation, and you'll see a more intensive diligence process. When a company gets to an M&A event or an IPO, that diligence process could be weeks long. For an IPO, I know that I've been a junior associate working on putting together a binder full of verification of all kinds of documents. That's actually a requirement at that point. And really, the cost at that point will also increase. But if you're writing a bigger check, taking a larger risk, that should be expected, and that's kind of a known quantity that you're taking on then. Some examples of things you might do at that stage that you wouldn't have done for an early stage company is you might review all the material contracts they have above a certain dollar threshold with customers or vendors or both. You'll review every stock and option issuance. Well, you won't, but the associate at a poor law firm that you're sending to work all night will be doing that. And you might undertake litigation searches depending on the business they're in. You might undertake lien searches. It could be any number of things, and the costs will start adding up. So the last point to make is the lead investor is generally handling the main diligence effort, especially on a priced round. But given that there's such high competition for some of these very hot companies, there can be a lot of motivation to just get a deal done as quick as possible because there's competing offers, or getting into a round that's being led by a great VC, and you really just want to close and you don't really feel the need to go through anything or do a thorough diligence process. So when that happens and it just builds and builds and builds upon multiple rounds, you can end up in a scenario like the Theranos debacle that's on the detailed in the book that's in the image there, which I'm sure some people have seen and got a little scared about. But that's all we have in terms of specific content today. Happy to answer questions for the next 15 minutes or so. So I'm going to jump to the Q&A slide and invite Patrick back on here and see what you guys are wondering about.
Great. Thank you so much, Amit. That was incredibly insightful. And for the Q&A section, if you have not already done so, please submit your questions in the Q&A tab at the bottom of the screen. I'm going to be moderating them. Unfortunately, we most likely will not be able to get to all of them, but we're going to share some contact information should you wish to follow up. And now moving on to, wow, so many questions just came in. So let's see. So there were several questions basically that we got before the webinar, and I'm seeing right now in the Q&A section about recommended tools that you would recommend for early stage startups, pre-series A, to get their documents, et cetera, lined up and organized and ready to send to VCs?
Yeah, that's a great question. I think also tools, but the organization is really important. I think the basic items that I listed on that sample legal DD guide, you could follow that pretty closely and put those all, even as simple as a Dropbox folder, and just make sure everything is labeled. Very typically, when a VC is looking into your company, they're going to send over a diligence checklist with, a commercial category, a legal category, and a few other points, and they'll list what the different items are. It can be very annoying, but if you just title your documents to fit with their checklist, it will make everyone's life a lot easier. And if you make everything easier for them, you'll get a faster response. You'll get a quicker turnaround. So I would say organization is super key when you're responding to that kind of thing. That would be the basic starting point there.
Great. And then in terms of exit strategy, we have a question from Tiago Notal. What would you recommend for due diligence processes and exit strategies? And where should you look for some sort of methodology about doing that?
So I think, there's not going to be a perfect answer there. If you're trying to think about the exit strategy for a company, you might want to look at comparative exits that have been in a similar space. That would be the most relevant thing that you have, but obviously things change. You might look at, how the IPO market has gone for companies of that sort. Like for biotech companies, the IPO market has always been fairly strong. Whereas for a long time, if you're an enterprise SaaS company, there was a long gap where there wasn't very much of that. So I would say industry comparables would be the first place to start. But beyond that, you might want to think about, well, what is this a compatible business with? Is this something where there are very active companies in M&A in that area? Most exits are going to come from M&A and not IPO. So does something seem like a natural M&A target? That would be another angle you could look at. If you're a VC that has particularly close connections to those companies, you might have a better understanding of, is this something that would be attractive to an Oracle, a Cisco, or some of the other really big acquirers out there?
Great. And we have two questions that I'm going to link together here. One is, could you provide you don't have to give proper names, but a horror story of how not having due diligence really messed something up? And then how due diligence could have made a difference in that case. So learning by failing, basically.
Yeah. How much time you got? Yeah, I think there's a lot of cases of things like that we've seen over the years. Some that we felt that maybe we could have some control over, some that are, a little harder to see. I think one that comes to mind is there's a company where there was a bad experience with a certain founder in the past. And after that person, their initial company failed, they actually became part of the founding team of a different company. And they weren't listed as a founder. When we went through all the checks of the company initially, it wasn't clear that that person was involved at all. We didn't really get into the whole team that they had at the time. And then later, when that person was involved, it became a bigger problem that that person hadn't been as forthcoming with their first company, and the new company eventually had similar problems. But yeah, I think that's a team issue of you might only look at the founder because you don't know who else is working with the company. So maybe it's important to understand who the whole team is if you've had certain experiences with certain people.
Awesome. Yeah, I didn't want to put you on the spot there, but so we have a few questions about dividing responsibilities between for legal due diligence between the lead investor and an external lawyer. Can you clearly define what both of those roles would be in due diligence?
Yeah. So if you're the lead investor, typically what you're doing for a priced equity round, so like a typical Series A, you're going to pass all of that legal diligence pretty much to the law firm or whoever you're using as that for that provider. The At that point, what you're relying on is for that law firm to surface any issues and come to the investor and say, here's what we've found. Um, how would you like to proceed? It could be something very minor where you would say, oh, this is not an issue at all. Let's just keep going. It could be something where you say, okay, we see an issue with this stock issuance. Please get it fixed before we're going to close this deal. It could be something where maybe they haven't registered to do business in some state that they're doing business in. And you might say, hey, relatively minor issue. And you would change the investment docs to say, please get this done within 30 days. But primarily the responsibility to do that is going to come from the law firm of the lead investor. So if you're writing a smaller check into that same round, you're not typically going to do any of the legal due diligence there. All of that's going to be done by the lead investors counsel. The commercial diligence, you're still going to make your own evaluations, and feel free to ask the company any questions to verify your model or whatever it is that you're doing to make your decision on investing in this company. But on the legal front, it's just going to be lead investor counsel.
Great. And then quickly, kind of based off of that, so you always want to pay a law firm to do the due diligence process, or who would you pay?
Well, the law firm will handle the legal side of the due diligence process. Again, this is going to be a function of what stage you're investing and how much you're investing. If you're writing a $50K check into a Series A, you're not going to pay a law firm $10,000 to $15,000 to spend hours looking at the documents again. If you're investing in a very early stage company and you're familiar enough with the basic documents and you see, the stock issuances are right, the cap table is right, you're bullish enough on the market, and you see that other, institutional investors have been involved, you might feel comfortable taking that risk. But it's a risk that you take if you think that there might be issues. You can find some more solo practitioners that might do some basic legal diligence for a lower rate. But at that point, you really want to take cost into account, because how much are you spending relative to your investment to do that diligence? So there's some basic things that I would think investors can get really familiar with. So early stage legal diligence doesn't necessarily have to come from a very expensive top tier law firm. But when you start moving into priced later rounds, that's typically what would happen, and I'd recommend.
Awesome. All right, so here's a great question. In your experience, what's the biggest killer of pre-seed stage deals?
Biggest killer of a pre-seed stage deal. I don't know. I think it could be a variety of things. I would say if the team is not forthcoming when they're challenged about some of their assumptions, if they don't seem like they're understanding or taking feedback well, or open to any sort of other points of view or coaching, I think that can really hurt an investor's confidence in working. It's one thing for somebody to have made a target market that was way too large with some assumption that they might have been slightly mistaken about. But when somebody brings it to their attention and they don't show any sort of ability to process that and move forward and reformulate anything, I think that can be a real killer for some people to want to back something. Because like I said, at that stage, you're really, really investing on the team. And if the team doesn't seem like somebody that could adapt or learn from any challenges or understand that they don't necessarily know everything, I think that would be that I've seen be an issue in the past.
Great. And we have quite a few questions focusing on international companies, cross-border due diligence, essentially. What would you recommend for someone for a Canadian startup, for example, to work with U.S. investors, or any country X with U.S. investors?
I would say there are more and more investors that are willing to invest in global companies from the U.S. I think the easiest way, and this is the advice I give to all of our portfolio companies as well, is that if you're trying to get U.S. investment, the easiest way is to incorporate in a form that will be familiar to them. So to have a Delaware C corporation as the parent company, and then that would be the 100% owner of the operational entity wherever you're located, whether that's Canada, Mexico, or anything else. I think that puts things in a format for that people understand. And then the investor forces to undertake the diligence in those other places. But from the perspective of the startup itself, by doing things like that, you take certain questions or roadblocks off of the table. I'm not saying it would be impossible to raise money as a Canadian company in the US without doing that, but you open yourself up to a broader pool of potential investors by doing something like that.
Great. I think we have time for maybe 2 more questions, and this one's from someone who actually sent in questions beforehand, so thanks for that. How do you validate your metrics? Do you ask for access to the analytical platforms that they use?
Yeah, I mean, I think that's a completely valid thing to ask for. If you're wanting to know more about how these numbers look, or how did you achieve this kind of growth? Can I take a look at what this is? I think it's completely valid to ask those type of questions. You should always feel free to ask the questions of the company of things that you're trying to validate or understand. If they don't want to share it, sometimes it could be a very valid reason and they'll tell you why. But if they don't and something doesn't feel right, then maybe that's a factor in your decision. But it never hurts to ask. And I think there's a completely logical reason why you would ask. So if the company doesn't want to do that, maybe that tells you a little bit of something. But it's different if you're asking like, hey, can I see all of your code and can I get like a down? Well, we don't really want to share that with every single person that we meet with. But if you're looking at just like kind of raw numbers of their analytics, I think it's a valid question. But that kind of question and things of that nature and the commercial diligence is something that we're going to have another webinar specifically focused entirely on that if you're on this mailing list, you probably will get another email in the next 2 to 3 weeks setting up that next webinar. And to everybody that did ask a question, to the extent I didn't answer in the same way that you're expecting, it's a little hard with no back and forth in a webinar scenario, but please feel free to send your questions in and happy to try to give you as much information or guidance as I can.
Awesome. Well, thank you so much, Amit. Could you go to the next slide, Amit?
Yep.
Great. And that is unfortunately all the time we have today. There are a bunch of questions that we were unable to get to. A lot of them focused on kind of readings that folks can look into about clarifying their due diligence tactics and some other kind of listed methodologies about how to do so. So maybe we can get back to the group with some options for that. We additionally will be sending out a recording of the webinar to all the registered participants. So if you missed anything or joined a little late, feel free to re-watch at your leisure. And yeah, if you'd like, so again, I want to mention our Venture Capital Unlocked program. If you'd like to learn more about deal flow, due diligence, and many more topics, please check out this upcoming Deal Camp at Berkeley program. It's coming up quickly, February 11th to 14th. Remember to get your application in as soon as possible. The window ends, I believe, this week, and we only have a few spots left. Feel free to reach out to me at patrick.driscoll@500startups.com if you have any questions about Deal Camp, or if you have any clarification questions about the webinar as well. And with that, Ahmed, any other final words?
Nope. Thanks everybody for joining, and hopefully it was helpful, and you know, happy to serve as a resource and hopefully send you some good content in the future.
Fantastic. All right. Thanks everyone so much, and have a great rest of your day, night, afternoon, wherever you may be. Thanks. Bye.